I want to ask our next guest whether it's time to buy stocks, and I have 37 follow-up questions. Joining me now, Research Affiliates founder Rob Arnott. Rob, before we get to stocks, how quickly do you think the Fed can bring inflation under control?
Well, firstly, the Fed was wildly off the mark when they said this was going to be transitory. If you define transitory as within 5 years, sure. But the pressures, the inflationary pressures are powerful, sustained, and will last for a while yet. I would say if you're looking at 2 to 4 years from now, it's a good possibility that inflation will have moderated by then. But watch out for 2022 and 2023 and perhaps 24.
You've taken a bearish view on stocks at times. You pointed out that when valuations are high, we can expect future returns to be low. Have we seen enough of a markdown to get you more optimistic on stocks?
Optimistic would be a little strong. For U.S. stocks, I think the market is pricey. One of the things I like to look at is what's called the Shiller PE ratio. That's price relative to 10-year smoothed earnings. That's about 32 times. Historic norm is about 18 times. So if you get back just halfway to historic norms, you'd be looking at a drop of another 25%. So when markets drop, the forward-looking return improves. They have dropped. Forward-looking returns have improved. Have they improved enough to be interesting? Not really, except outside the U.S. Europe, Japan, emerging markets, all priced much, much cheaper.
I want to come to that, but tell me about value stocks in particular. They've rallied. Are they still cheap, and are the FANGs still expensive?
This is one of the things that's really surprising. The spread in valuation between growth stocks, FANG type stocks, and value stocks. August of 2020 was the widest spread ever, wider even than at the peak of the tech bubble in the year 2000. Now, because value has snapped back, they're no longer nearly as cheap as they were in August of 2020, but they're still bottom decile cheapness. They're still very, very cheap. What we saw after the tech bubble burst was that value outperformed for the next 7 years and outperformed growth by over 100 percentage points. So what we're looking at now is value is still very cheap. Value would have to beat growth by about 4,000 basis points, 40 percentage points, just to get back to normal, let alone to get to a point where value is expensive.
And the dollar recently hit a 20-year high. So tell me about that comparison, overseas stocks on valuations versus the U.S. Would you be putting more money overseas, and what are the risks?
Well, this is one area where the relative valuation comes into play. Foreign currencies falling and those stock markets tanking alongside the U.S. means that those markets are cheap and in dollar terms cheaper. So we look at I mentioned the Shiller PE ratio. For the U.S. it's 32. For non-U.S. developed economy stocks, it's just under 20, and for emerging markets, it's just over 15. That's cheap. So I look overseas and I think there's lots of opportunity to be a bull, just not if you want to be centrally focused on mainstream U.S. stocks and bonds. Bonds I would put in the same category. Bond yields have gone up sharply, but they're still not interesting. If you've got 8% inflation and bond yields are in the 2 to 3 range, well, that's a -5 to a -6% real rate. One of the things I think about interest rates is that the real rate acts as a speed bump to discourage reckless investing, to discourage dissipation of resources, malinvestment. And that malinvestment can be either at the government level or the corporate level. So what we have is actively encouraging dissipation of resources.
Are we going to get a recession this year or next year?
I would think that it's reasonably likely that we will. I don't think that the odds are as high as a lot of people suggest, apart from the stock market's indication that the economy is in trouble. Falling stocks have predicted, I think Paul Samuelson once said, falling stocks have predicted 9 of the last 5 recessions. And so this may be one of those cases. But, war is inflationary. War creates complications for the industrial sector. But that paired with supply chain disruptions can wreak havoc. On balance, I'm not an undue pessimist when it comes to the risk of recession.
That sounds downright optimistic, that part there at the end. Thank you, Rob Arnott.